Hello everyone. This is the second video in the series. Today, one of my friend asked me to make a video on hedging, hedging in future trading and options trading. So I thought to make a small video. Hopefully this will help you understand what hedging is and how to do hedging. Now, if you're doing options trading or the futures trading, see in options, either you sell options or you buy options. In either case, let me share my screen. Sorry, I forgot to. All right. So in options trading, either you sell options or you buy options. And you know, when you sell options, you earn as the time passes, even if the stock remains at the same price. So with the time dilution, you earn. Similarly, when you buy options with time dilution, you lose money. Now, the biggest problem why people lose money in options is that you at least have to buy one lot, buy or sell one lot. And most of the people like option buying because it requires lesser money. They don't have a huge account. Option selling requires, many times the money in comparison to an option uh, buying. Option buying is much cheaper than option selling. So the reason people lose money is let's say they buy a lot, right? Let's say they buy a lot of Tata Motors. So let's say Tata Motors spot price. Spot price is the current stock price. Let's say it is 284 rupees today. So if you buy a call option, let's say your view is that Tata Motors price will go up. So you buy a call option of the strike of, let's say, 290, right? So as the price starts moving up from here, you will earn money. And let's say the premium of this strike price call, let's say, is 10 rupees. So as the price moves up from 284 and goes towards 290 and goes above 290, your premium will increase, and premium can increase many folds as well. It can go 100%, 200% up as well. But it will dilute with time. If the price of the stock remains at 284 or falls down, because it's a monthly option, as you approach towards the end of month, the premium will go down, and eventually it will become zero if your strike price of 290 is not achieved much ahead of close of the month. So because of these reasons, the option buyer is at a very high risk. Like, you have to be an expert to be an option buyer. Option selling is much more easier. But what you can do, so the biggest risk is that as soon as the price starts moving down, the lot size of Tata Motors, let me see here. Let's see, Tata Motors. So let's say 290 September. You see the lot size is 2850, right? So if you take one lot at 2850, you have to spend like 35,000, roughly 35,000 rupees. Now the problem is that as soon as the price, you buy this considering the price will immediately move up. Most of the times, an option buyer wants to play the momentum. So you want to see that price immediately moves up when you buy it, but that normally doesn't happen, right? price starts moving down and you start to lose money very fast because lot size is big. Even if it goes 1 rupee down, you will lose 2850 rupees. And if the premium goes down, let's say 2 or 3 rupees in a very short time, you'll start losing money, and very soon you'll see that you're losing 10K. So that's where you will get out of the trade, considering that you're already losing 10,000 out of 35,000 rupees you have invested in this, and you'll get out of trade. And mostly what you will see is that the moment you get out of trade, after some time, the stock starts moving up and goes much, much higher. So this is where hedging comes into play, right? So you should be in the trade for long enough. Like mostly you should be in a positional trade rather than intraday to be safe, to be on the safer side. Um, it's mostly better to buy options when you have a lot of time, like at the start of the month or before mid of the month. You have a couple of weeks to expiry. This is a good time to buy. So let's understand what is hedging, right? And I'll talk about hedging from an options perspective. Let me show you a hash trade. So I'm using Zerodha, and if you go to orders and you do go to basket, create a new basket. Now let's talk about Tata Motors, for example. So I give a name of the basket as Tata Motors, and I want to buy an option of, let's say, 290 September CE. CE means the call option. So it's 35,000 rupees. Now to hedge myself, what I will also do is I'll add another Tata Motors. Now this time I'll sell a call of a higher price than my earlier transaction where I bought a call. So here I bought a call of 290 rupees and I'll sell a call of 300 rupees. So it's roughly about 60,000 rupees, and you're able to, I'm sorry, I think I bought this, I need to sell it. You see, when you sell a call, you need to pay a big amount. Here it is 2,11,000 rupees. But the overall margin, if you see, I'm paying is only 40,000 rupees because I'm hedged. So what will happen here? Tata Motors September 290 CE call is of premium 12 rupees 45 paise. And Tata Motors September 300 CE call, which I sold, is of 8 rupees 85 paise. Now, as the price moves up, this one will move faster. The premium for this one will move faster. And the premium for this one will move slower. When the premium moves up, I will earn money in the first one because I bought it. And if the premium moves up, I will lose money in this second option, right? So let's make some assumptions. Like this one is 12 rupees 45 paise. Let's say Tata Motors goes to 290. The current price is around 284 or something. When it goes to 290, I will start earning here, and this option may go to, let's say, 20 rupees, right? Maybe 18 rupees. So you earn like 5 rupees, 5.5 rupees. And this one will go up by 2 rupees. So overall, if you will see at that time, when the price of Tata Motors goes to 290, you'll be earning 3 rupees multiplied by 2850. So roughly around 7,000 rupees you'll earn. So a question may come into your mind, like, why do I add this to the second one when I can earn more here? And the reason is, let's assume the price starts moving down. As soon as you buy it, the price sharply moves down. So this option, which was like 12 rupees 45 paise, will move down, let's say, to 6 rupees. So you'll lose like around 12,000 rupees on this one. And this one moves down, it will move down 4 rupees. So as it moves down, you will earn money here because you sold this option, right? So you will earn some money here. Now, as the price of Tata Motors keeps going down, you'll see that your loss will almost remain constant because this will keep covering your loss. So you will be in loss for sure, but it will be almost constant or increasing very slowly, which will give you confidence to be in trade for longer time. Or what you can also do is, when the second one has given you enough profit, right? And you see that the price has moved down to a support level where it will start moving up, you can get out of this trade so that you earn all the profit from here, and then you can ride this trade up. Now, for doing these kind of adjustments, obviously you need to have a very, very good knowledge of options. You need to understand whether your premium will go up or not, how much time is remaining, what is the volatility in the market, whether the price of the underlying price of the stock will go up or not. You need to be aware about all those things to take these trades. But hedging is I really like hedging. I mostly don't take any trade without completely hedging it, because when you are hedged at max, you will lose few thousand rupees. For a considerable number of days you can be in trade, and if you are taking your trade at the right price, where the risk to reward is really good, um, then you will always benefit. Now let me give you an example of how to take a beneficial trade. Now, let's take a look at this Tata Motor chart, and I'll be looking at the daily chart. Now you see, at this point here, you'll see multiple lines here. This green line is 20 EMA, 20 daily EMA. The red line is 50 daily EMA, and the pink line is the 200 daily EMA. Now you see here that the price came down to 200 EMA, and we know that 200 EMA is a strong support. So is 20 and 50. So here you can take a trade, right? I mean, you're confident that at least once it may bounce from here, and the risk to reward is very, very small. Like I can just, I can take a trade at 274 and put a stop loss on 4 rupees, right? Now, let's say if you take a call here, when the price is 275 and you take a call of, let's say, 280, you see the price moved here down to this level, 266. So ideally, this would mean that you lose good 10, 15,000 rupees. But if you take a hedge trade, your other side of the trade, the the selling of call option will give you some money and contain your loss to no more than 4 or 5,000 rupees. So you can take a trade here, consider 5,000 rupees as your stop loss for both the trades, the call buy and call sell. Keep hedged. Now you will not uh, get out of this trade because you know that you're hedged. You're not going to lose huge amount of money. And as soon as the price started moving up from here, you see it went to 288. You might have earned your call buy might have earned like good 15,000 rupees, and your call sell might have given you a loss of 5,000. So you still remain in 5 to 6,000 profit. So that's how hedged call work. If you have more questions about hedging, do let me know. I can make more videos. Similarly, you can also hedge futures. For example, you can go to basket orders, and let's go to Tata Motors again and delete these two, and I take a futures trade on Tata Motors. So I'm taking a September future. Now, if you take a look at this, you have to pay 2,46,000 rupees. I add that. To hedge this, what if the market goes down, right? So I will take a put, let's say of 260 rupees or 270, right? I'll take a put. Just 7 rupees. When you hedge a future with a put, um, take a put with a lower premium. Like we are just at the start of the month, so these are expensive. So I'll rather take, let's try 260 PE, which is 5 rupees. So I'll take this. Now you see, if in futures, what's the problem? So price remains here, you are not at loss, right? Futures price, unlike option, it does not dilute with time. So if the price remains here, you're fine. If the price goes down sharply, your PE will give you good money. This premium will bounce from 5 to 7 to 8 to 10 if the price continues to go down, and will give you some hedge from the loss you're making from this. Right now, remember that you will not go down significantly, right? Because you're taking this trade at a very good level when Tata Motors is at its support. So most of your trades should be in a way that you take a trade at the support, right? But sometimes it happens that you take the trade at support, but the support is broken. For example, here 286 to 87 was a very good support for Tata Motors. You see multiple times it took support here. So someone could have taken a trade here and then it went down sharply. So his put might have given good amount of money to him. And when he sees that we are getting a reversal from 200 EMA, he should have got out of the put and continued to carry future and earn money on the future side. That's all for now. Thanks a lot. Bye. See you again.